Hello everyone, welcome back to Residencia. In Residencia we help people to be defended by international tax audit or from aggressive tax jurisdiction that wants to tax audit your foreign business because it's considered against some anti-abuse law. So here in this firm we help entrepreneurs to have undeniable proof to be always defendable with no issues. In this specific video, I just want to talk about the difference between having and owning an insurance in Luxembourg, for example, or a life insurance structure, which is the most common one in the jurisdiction of Luxembourg, versus owning a trust or owning simply a holding company that basically is supposed to be there to protect your asset, okay? What's the big difference and why this could be extremely efficient when you want to switch tax residence and you don't want to have issues from aggressive tax authorities that are going to requalify your substructure as a local one, or they found that you have broke some anti-abuse rules. Okay, so let me clear out this point because here is a very interesting situation that I want to clear out in this video. Now we have quite a lot of clients coming with this structure, so they are coming to us and ask us for protection defense file, and we try to help them to fix their structure to be bulletproofed against any tax audit. But this is the problem that normally we have to face. We have the classical case, easy one, holding company owned by an individual, okay, that wants to change tax residency, okay? Here's the classical situation because this person is living in a high tax country. So he wants to switch jurisdiction or wants to test different tax residents in different jurisdictions, but with him we have below a certain structure, okay, with others company below, etc., etc. Same problem when we have a trust. So this person is a beneficiary of a trust, okay, with the trustee and the settler, okay, maybe member of a family. So basically we have also this second option that normally comes to us. And the third option that sometimes is very tax efficient and very tax resident switch efficient, bear in mind my word, tax resident switch efficient, insurance, life insurance, such as branch 23 Luxembourg. It's a specific insurance issued by this jurisdiction, and this insurance has the peculiarity of this structure is that they have their own independence, they have their own administration, and they have their own juridical, their own place of effective management, which is the main issues of all the rest of the jurisdictions, all the rest of the structure. So imagine myself switching tax residence from a country to another. What happened? It happens that the new country of residence of me as individual see what I have below my structure. So, and if I have this structure in a low jurisdiction country, my new country of residence could apply the CFC rule, controlling foreign company rules, could apply the place of effective management rule. For example, if I move myself here, I am also the administrator of the company or one of these sub-company here, one of those sub-company could be requalified as a local one in the new jurisdiction in which I'm living. Same for my trust. If the trust is not set up in a certain way, so this is the worst case scenario when I bring with me all the holding and operative companies which are not well set up. Okay, they have their own independence, their own directive place office in order to avoid the requalification through the permanent establishment issue or the place of effective management issue. Then also the trust that I have below my person has to be incorporated in a jurisdiction which should not be blacklisted. Otherwise, the new jurisdiction which I'm moving to could see this as a fake structure, just to avoid to pay taxes. So we have to be very careful when we have this structure beneath our feet, let's say. But this one has the peculiarity of passing basically all the most aggressive and stricted anti-abuse rules, especially in the European Union. You know, Luxembourg is in a European Union jurisdiction. It is in the heart of the worst and strict number of anti-abuse rules applied throughout the European Union countries, okay? So if this structure is a bulletproof, the fact that it exists itself, this insurance that behaves very similar to a trust, but is not a trust, it makes it basically a product bulletproofed, again, place effective management, purpose test against the GRR anti-abuse rules, local national anti-abuse rules in the country of residence, or the new country of residence, and I avoid any requalification, which is the most important part, because if this one is an independent structure, because I'm gonna put all my wealth inside this wrap here, along with all my companies, as long as the company have their own independence still, then wherever I move myself, even if I switch in several tax jurisdictions, this structure remains independent because it's an insurance. It gives me back money when we establish when I should receive this money based on the contract with this insurance. Could be monthly, could be annually, could be when I'm dead, depends. But this insurance has the purpose of managing your wealth. Sorry, my pen is dropped. Has the purpose of managing your wealth as your interest in order to give you a certain amount of money, which will be requalified as a capital gains, you see? So the things of this insurance is not just incorporating all your wealth, and has the purpose of improving your wealth, exactly like the trust does, but it's not a trust, okay? And is making your company working, so this insurance will be the main shareholder of your structure, you see? So they have the double purpose of giving you direction of your wealth, take care about your wealth, and turn all your wealth in one type of income, outside type of income, which is called capital gains. Why? Because whatever product you put inside the insurance, the wrapped insurance, for example, branch 23 Luxembourg, it turns into capital gains, okay? And the capital gains, in most jurisdictions, several jurisdictions in the world, is the least tax type of income, okay? And you can also differ the payment in a different tax year, so you can wait to get paid when you switch your tax residence. And everything beneath the insurance is not affected by your tax residency changed, because this insurance has its own independence by default. Okay? I hope I gave you some hints of how to really build your structure in order to be bulletproofed against any tax audit, and at the same time protect your wealth. See you in the next video. Bye.